Bill Ackman, a millionaire investor, just lost $400 million in less than 90 days, and we'll discuss what happened in this video. Ackman is one of the most keenly watched and regarded investors on Wall Street, and for good reason. His fund, Pershing Square, has made billions of dollars in gains for its clients, but for all of his success, Ackman has had his fair share of mistakes. This includes a $3 billion loss on an investment in a business named Valiant Pharmaceuticals, as well as a failed short bet on Herbalife. He just added to this list of disastrous investments with his stake in Netflix. Ackman's funds lost $400 million on this investment, which he only held for 3 months. Now, the ultimate purpose of studying famous investors' blunders like this video is to assist us in avoiding losing money. To paraphrase investing guru Charlie Munger, making mistakes is one of the finest ways to learn, and it's even better when you can learn from the mistakes of others. Learning from the mistakes of others is free. If you can learn from the mistakes of previous investors, you won't have to learn the same lessons with your own money. That's what we'll look at in this video. Why Ackman invested in Netflix, what went wrong, and what you can learn from this investment blunder to apply to your own investing. Let's get started, but first make sure to like this video and subscribe to our channel. Let's get started with this video. One of the amazing things about Ackman's investment was that he clearly laid out why he acquired Netflix, and then once he sold, he put out another letter detailing how he got to that decision. Despite its current difficulties, Netflix has been one of the best performing companies of all time. You might have purchased the shares for a split adjusted price of 47 cents in October 2002, just after its initial public offering. That same share may have traded for as much as $690 in October 2021, 19 years later. If you had invested $10,000 in Netflix in October 2002, that $10,000 would have grown to $14.7 million in October 2021. That would have been a very good return on your investment. Netflix has grown from a mail-order DVD rental service to the world's largest streaming service, spending tons of billions of dollars on original content along the way. Netflix's growth as a corporation and its stock returns for investors earned it the moniker FANG stock. Other FANG stocks include companies such as Facebook, Amazon, Apple, and Google. Netflix will be joining an incredible list of stocks. However, beginning in late 2021, Netflix's stock price began to fall. There were other forces at play, both specific to Netflix as a company and those affecting the broader stock market. Rising interest rates were one of the factors weighing in on Netflix's shares, as well as the stock prices of other high-growth firms. All else being equal, rising interest rates reduce the value of a company and as a result, the stock price of that company. Rising interest rates now have an impact on the value of all equities, although some corporations suffer more than others. Due to competition as well, investors became afraid that Netflix would not be able to grow its subscriber base quickly enough. This caused shares to fall from a peak of over $690 per share in November 2021 to around $390 per share just a few months later in January 2022. All of these elements paved the way for Bill Ackman to invest. Throughout his career, Ackman has made investments in otherwise brilliant companies that have faltered. Netflix, Ackman said, was another Chipotle type of investment, a company with a temporary speed bump but overall a wonderful business. Before I go more in depth on why Ackman bought Netflix, please like our video and subscribe to our channel for more material like this. Let's now return to the video. One of the reasons I enjoy studying Bill Ackman is that he is extremely open about why he makes particular bets. In his letter to investors, Ackman outlined his investment thesis, or to put it another way, why he favored Netflix shares. This argument focused on two key components: subscriber growth and pricing power. Netflix's business model is subscription-based. This generates what's known as recurring revenue for a corporation. Let me explain why investors adore so-called recurring revenue. In most industries, when a company makes a sale to a customer, the connection between the company and the consumer is over. Obviously, the corporation hopes that the customer would return to purchase another product or service, but this is far from assured. Most businesses must spend money on advertising and promotions in order to entice the customer to return to the store and shop again. With a subscription model, you make your sale once by getting the consumer to sign up and provide their payment information, and then you can sell to that customer again and again. You put in the effort to convince the customer to join, and that person will be a customer for the foreseeable future. The subscription model has the advantage of being much more consistent and predictable in terms of revenue. Subscriber growth is obviously one of the most crucial indicators in a subscription model. Ackman's thought process was that Netflix will be able to continue growing its subscribers despite the streaming conflicts as we outlined previously, but this was not the case. Netflix revealed its first quarter results for the year on April 19th, and they were not good. Netflix lost 200,000 customers in the first 3 months of 2022. It was the company's first loss of subscribers in 10 years. Worse, the firm stated that Netflix will likely lose another 2 million customers over the next 3 months. As you may imagine, this was bad news for investors. Investors sold the shares in droves, sending the price down even lower. Bill Ackman was one of those investors who sold his entire interest in Netflix after the news, resulting in a $400 million loss. Netflix has spent tens of billions of dollars on advertising as well as generating its own original content for years. The second important aspect of Ackman's concept concerned pricing power. This is a concept under which a firm can raise its prices without facing much opposition from customers. The revenue equation for subscription business models is simple. Multiply the number of subscribers by the amount each subscriber pays. This gives you the revenue generated by the company. Ackman argued that Netflix had enough of a competitive advantage to charge more than competitors without losing users. Netflix's regular package is $15.49 per month compared to $7.99 per month for Disney Plus and $4.99 for Apple TV. For years, Netflix was the only game in town when it came to streaming, so it didn't compete with other streaming providers. Instead, it competed with cable relative to cable. Netflix has tremendous pricing power. A basic cable plan costs roughly $60. Netflix is only a fraction of the price of cable. However, considering Netflix's recent performance, Netflix's pricing power may have simply vanished as a result of the surge of various streaming platforms. Because there are so many streaming options for consumers, Netflix no longer has to compete solely with cable. In addition, the corporation must compete with other streaming services, many of which offer lower costs than Netflix. Because there are so many streaming providers, Netflix's ability to raise its fees is limited. In light of these shifting circumstances, Bill Ackman chose to sell his share in Netflix after only a few months of ownership. Now, what can we learn from this investment? The choice of when to sell a stock is one of the most difficult for all investors. Whether you're operating a multi-billion-dollar fund like Ackman or investing your savings from your first job, looking at Ackman's Netflix investment can help us understand how to handle this challenge. Being a long-term focused investor is the only way to actually achieve high financial returns. However, as long-term investors, we must walk a fine line between holding onto a company through market volatility and being willing to give up and sell if the core fundamentals of the company have altered. And that just about wraps the video. I hope you appreciated the video. Please give us a like and subscribe to our channel if you enjoyed our stuff. See you in the next video.